Understanding the best time to purchase a stock can add up to huge returns over a long period of time. And what we're looking at in this particular video is AT&T stock over a particular time frame. So let's say we set this to 6 months in Google Finance. You'll see that AT&T has more or less traded sideways over the last 6 months and even the last year or longer. And the reason that this is still a good investment despite not increasing much in value, you can see it's only gone up about 5% in a year's time, is that they've been paying a pretty big dividend this entire time. So what we are looking at is when the stock dips. So if you were to purchase AT&T stock, if instead of regularly purchasing, if you were able to always buy when the stock was down around $33 as opposed to $37 or $38, you would have much more money than if you had just put it in at an average price. So what we're looking at here is in determining what's a dip and what's not is looking at the moving average. So what we can do is we can click technicals here and then click simple moving average and then change this to 50. So this gives us the 50-day moving average of AT&T stock. This is basically the average purchase price of the stock over 50 days. And what we can do is anytime the stock is significantly below this line, that means you're experiencing a dip. So we can look at this, all the way up to the most recent day, and we can say that AT&T, now that it's up to $35, it's no longer at a dip. So, it's not a bad price to enter the stock. I still think it's a great investment. But once you're holding the stock and you want to add more to your position, it's best if you can find these, wide gaps, this is almost 10% in some cases, between the 50-day moving average and the actual price per share. And if you're always able to buy at this big dip, you're just going to end up with about 10% more stock for your money, which is going to significantly increase your potential. And this works best on bigger stocks. A stock that trades very rapidly is going to be hard to find under its 50-day moving average. So for example, let's look at Tesla. If we set this at 6 months, there's a time period of many months where the stock was unable to fall beneath this line. But you can still find that eventually it did, and when there was a big gap, that would have been a nice investment. Now we're back up over the 50-day moving average, maybe not the best point to enter this stock. So a fast-growing stock, it's hard to use this system, but it's really great for stocks that you've been holding over a long period of time. Let's look at another favorite. You'll see that the 50-day moving average for this stock, again, not very many times where it's been below the moving average. So if we were to set this to, a longer period of time, we would see that this was a great opportunity and this dip was a great opportunity. Both times under $400, you wouldn't have missed this. But when a stock's generally trending upwards, this doesn't work. It's best for a long-term stock that you've been holding for a while and it's steadily growing, and you want to add more money to that investment. So try this out. Again, we click technicals, simple moving average, and 50 days. That's just a good point for evaluating a dip. And what we want to also discuss is there's a difference between a dip and an overall downward trend. So for example, if we looked at Apple here, you could be thinking, oh great, this is way below the moving day average, which was $500, and continue to go down to $390 or $380 something before finally picking back up. So it's hard to tell, the difference between an overall downtrend and just a dip in price is looking at the company's financial statements. So like if we're looking at AT&T, honestly, nothing really changed about this company in the last 6 months. They've been steadily selling cell phones, they've been steadily collecting money, and they've been steadily paying a dividend. This dip represents nothing other than investors moving out of the stock, rather than something wrong with the company per se. And as you can see, it's recovered, and then again it'll dip, but then it recovers again. This is just how the stock trades. So instead of, putting your money in steadily every paycheck into the stock position, you want to set this up and wait for it to dip under its moving day average, then continue to add shares while it's under. Here, you could have added some money at this price, and then some money at this price, and gotten your average purchase price down. You're not going to nail the bottom, but this is a good practice. And the reason this works is because at different times, different stocks in your portfolio are going to be below the moving day average. So let's say every month you're able to put $500 or $1,000 in the stock market, rather than investing in all of those stocks, you would just buy the one particular stock which is at its lowest price compared to its same day or simple moving average. So, 1 month it might be AT&T, the next month it might be a different stock you're holding. You just purchase the lowest price stock each month rather than adding to each position evenly. And as long as you don't continually buy the same stock and try to keep it somewhat even, you'll get the best overall price for your investment. So that's just a good investing strategy for how to buy stock, and I hope this video is helpful for you.